Hi, I'm Eric Rodriguez, certified financial planner, and today we're going to be talking about the top 5 financial planning mistakes I see with people that are either close to retirement or in retirement make. Now, before we jump through these 5 mistakes, I also want to share a client profile with you because through proper planning and customization, you can combat these 5 mistakes and really solidify your financial future. So why don't we jump into the client profile? So we have here Mike and Michelle Jones. Mike is 59 years old and Michelle is 60 years old. Mike has about $650,000 in his workplace retirement plan. They also have about $210,000 in a joint bank account. Michelle has about $800,000 in her retirement account. The only debt they have here in the red is a home equity line of credit at $100,000. And then they own their home outright, and their home is worth $1.2 million. They also have goals. So here's their high-level goals. So they have goals of retiring at 67. They want to be able to spend at least $6,000 a month during retirement for their basic living expenses. And they also want to plan for healthcare costs. They both have a history of healthcare issues, and both sides of the family have a history of long-term care needs like Alzheimer's or dementia. So they want to be able to plan for that. They do not want to be a burden for their children, so they want to take care of that. They also have a lifestyle vacation goal. They want to be able to travel once a year during retirement and spend around $10,000 per year. And then they have an adult child who's planning to get married in 2027. So they want to be able to contribute $30,000 to that wedding. So now that we have this high-level profile, let's walk through mistake number 1. So the first mistake is underestimating healthcare costs in retirement. This could be detrimental, and it could be a huge area where you can avoid breaking your financial plan by just knowing what your potential out-of-pocket costs may be. So typically when you retire, you sign up for Medicare, and Medicare covers a lot. However, Medicare doesn't cover everything, and Medicare has a significant potential in terms of you coming out of pocket to pay for medical expenses. And it doesn't cover some major things that could happen like long-term care. It doesn't cover home health care. You may want to get a Medigap policy, maybe a Medicare Advantage policy can make sense for you, but it's really understanding what are your potential healthcare expenses, because you need to be able to budget for those. So if we take an industry average of what retirement healthcare costs will be, we have a little over $6,000 each. This is national average for people that are retired. This is what they're going to potentially have to pay for retirement healthcare costs. So in addition, they also have a long-term care goal. They want to be able to cover their long-term care. So we're taking, again, a national average of maybe they might need some assisted living, and typically assisted living can last anywhere from 1 to 3 years. So again, taking a national average, it's about $64,000 each. So when we look at these two healthcare expenses, and if we actually jump into what their actual expenses will be in retirement, from a healthcare perspective, we can really see here, starting when they retire at 67, 68, we can see, the first year they're both retired, $17,000. And then again, this is adjusting for inflation, all the way into their 80s. I mean, this is significant money, over $30,000 every single year, significant money that has to come from somewhere. So if you don't plan for it, you're potentially going to be underwater and negative every single year. So we have to make sure we plan for that. Then, obviously the bigger expenses. So if they have long-term care events and if they last 1 to 3 years, these are potential huge landmines that could happen that can break your financial plan. So we can combat this again by having maybe proper long-term care insurance, again, looking at what our healthcare costs will be. And maybe there's a portion of our portfolio that we can allocate to pay for these expenses in the future, but not looking at these expenses, overlooking them is a huge mistake that I see. So we want to have a crystal ball and we want to prepare for this. Worst case scenario, nothing happens. Great. You have more money in your pocket, more money you can pass on. But we want to look at those. The next mistake I see is failing to adjust spending. So one of the mistakes I see with clients is that I'm in retirement, I have no debt, I'm good to go, I have all this money. Well, that's great and everything, but oftentimes, what if you're spending too much money? So in the Jones case, I like to run an analysis here where we basically run 1,000 different simulations: good markets, bad markets, anything that could be bad, healthcare events, lower Social Security, higher taxes, global geopolitical events, global events, etc. And then we take a probability of them potentially not running out of money. So, for example, if we look at their situation and we're like, okay, let's say, for example, they want to increase their spending. They're feeling good during their go-go years, and they want to start spending $13,000 a month. Well, now we have a 51% chance that we're going to be successful in retirement and that we're not going to run out of money. That is really scary. We don't want to leave a 51% chance that we're going to potentially run out of money, right? We'd rather see the score be 70% plus. But when we look at the details here, we look at the cash flows and we look at, okay, what happens to our portfolio over time because we're spending too much. Well, now if we look at the ending balance, because of all these negative net cash flows, we are running out of money. The Jones are running out of money at age 87, 88. So if they end up living to 90, 95, 100, they are not going to be able to survive. So we have to be able to adjust for these types of situations and make sure that we have a very structured cash flow plan in retirement so that we know we have guardrails, we know how much we have to spend, and this is what we need to abide by to make sure that we don't run out of money. And so a financial planner, or you can even do this on your own, but trying to figure out what does that number look like for you and what's going to be too much and what's going to be feasible, because that's what we need to figure out. So next we'll jump into number 3, which is not planning for longevity. So for example, going back to this situation here with the Jones family, if they stay status quo, they will run out of money at age 87, 88. And again, as I mentioned, what if they live to age 90, 95, 100, and they have these expenses that they need to pay for? What's going to happen? Well, a big red flag as I see with clients, because they come in typically with very conservative portfolios, is they're not giving their portfolio the chance to have their money make money, right? They're limiting their wealth building capability because they have too much conservative investments in their portfolio. So in the Jones family here, we'll look at asset allocation. Well, they have in their current portfolio, they have about 52% in cash, about 42% in conservative bonds, and about almost 5% in stocks. Where they really should be targeting is at least like a 60-40 portfolio, 60% in stocks, 40% in bonds, give or take. I'm not saying this is a recommendation for you. I'm saying for the Jones family, this can make a lot of sense. Because if we do this and we run their retirement analysis, if we show now a 51% chance of success, well, what if we get them back to their original, let's say even more, we'll give them some more money to spend. Let's say they spend $10,000. And then if we get them to their moderate portfolio goal, what we're going to see here is we're going to see their probability of success go up to 90%. And then we're going to see the comparison now, $5.7 million more by just adjusting their portfolio. This is the magic of compounding interest. This is the magic of having the right investments for your situation, because if they stay conservative, if they stay in their portfolio of basically cash and bonds, by the time they're 87, you see their or 88, you see their portfolio go to zero here. Whereas if they adjust their portfolio, they take a little bit more risk for their situation, $5.7 million more in ending assets. So you have to plan for longevity. If you're in retirement or about to be in retirement, whether you're in your 50s, your 60s, or 70s, you are a long-term investor. You have to plan for 20 plus years in the market. So having your money in conservative vehicles is not going to be in your best interest. Now that gets me to number 4. Number 4 is poor tax planning. So when it comes to taxes, we're going to jump into a couple of different scenarios here for the Jones family. But the first thing we want to look at is okay, where are our assets right now? Where are the assets right now? Because when you look at your portfolio allocation, your portfolio should not be the same in every single bucket, if you will. So for example, if you need to have a 60-40 portfolio, that has to cover all of your different asset locations. You don't want just a 60-40 portfolio in every single asset location. So for example, there's taxable accounts, which are like brokerage accounts. You have tax deferred accounts like 401ks and IRAs. You have tax-free accounts like Roth IRAs. So we want to be able to have the right asset location for our portfolio. So if we're intentional about this, we can plan an asset location strategy. So instead of doing a pro rata approach, we can take a taxable, tax-free, tax-deferred approach here. Again, we're just being intentional with this equity allocation. And what this does to our portfolio, here we go. What this does to our portfolio and our tax plan is, number one, just by having the right asset allocation, and making sure that your money is in your investments are in the right tax wrapper buckets, this is going to reap $338,000 more in tax adjusted assets, and you're paying $143,000 less in taxes paid. Now, the second area we want to look at withdrawal strategies. So instead of just winging it, which I see a lot of prospects and clients do, well, we want to be able to have a structured withdrawal sequence. So let's say we take a same approach. And again, this is not a recommendation for you. This is just an example of how a customized asset allocation strategy and withdrawal strategy can help you. But if we do a withdrawal sequence of taking our taxable, tax deferred, and tax-free distributions in that sequence, now we're seeing a little over $1.2 million more in tax adjusted assets, and then $540,000 less in taxes. So think about what that could do to someone's family, their legacy, et cetera, by not having to pay that. And again, just by doing some proper tax planning in retirement. So there's other fun things that we can do from a tax perspective. But these are just some samples and some ideas of what people can do and what they neglect, that can really, really help them generate that intergenerational wealth and help them have their money make money. And lastly is neglecting estate planning. So I see clients all the time that come in with a lot of assets. They have their homes paid off. They have, hundreds of thousands, if not millions of dollars in their retirement accounts and brokerage accounts, et cetera, but they don't have an estate plan. So these are some simple things you need to get. So Mike and Michelle need to get a will. They need a power of attorney. They need their healthcare proxies. They need their beneficiaries to be updated. They need a living trust. The best thing you can do for your family is to give them peace of mind, not give them the responsibility of transferring assets, left and right, not guessing what you would want them to do with the assets you leave for them. Just basically giving them concrete directions, legal documents that they can use to distribute your estate and have a seamless transfer. And potentially what happens with the tax code can be a potential tax saver in the future, etc. So having a proper estate plan, and we can go more detailed in estate planning, but also making sure that we have the right trust strategies. You might need a sub-trust. You might need a revocable trust, irrevocable trust. There are many different ways you can structure your estate plan. And again, this is just an example of a flow you can have of different strategies, because like I said, everybody has a different estate planning strategy. We'll do other videos on proper estate planning, but most importantly is at least get it started. Get these proper documents started. So there you have it. Those are the top 5 mistakes. So let me repeat them again. It's underestimating healthcare costs. It's failing to adjust their spending, not planning for longevity, poor tax planning, and neglecting estate and legacy planning. So hopefully you enjoyed that. If you have any questions, go ahead and ask them in the comments. Feel free to like and subscribe to the YouTube channel. Also, if you want more information about me and my firm or how we could potentially do this for you, you can check out our website, wealthbllc.com. Feel free to book a call with me. Thank you so much for listening, and I'll see you on the next one.